Hey everyone, Douglas here, Kenner Market Analysis, and welcome to the macro update for Wednesday, August 12th, 2020 at 7:24 a.m. Eastern Standard Time. And as we get things started for today's update, and we have a lot to talk about today. Markets, once again, in a very precarious situation. We will dive deep into that data in a minute. But where I want to start today is by picking up a series that I kind of hit pause on a couple weeks now, I think maybe over a month ago now. We were looking at kind of the layout of the overall macro economy and how to view the economy from kind of a flow of funds model. And I think as I just kind of describe what it is that we are about to look at and kind of go over the details, it'll make more sense. So if you haven't yet, I have a macro update playlist on the YouTube channel. If you go to the last few videos, you can kind of get up to date in terms of where we're at, specifically with the flow chart that you're looking at in front of you to make a little bit more sense of it all and go into a little more detail on each of the sectors that we've looked at to this point. But just to quickly kind of get us up to speed, in the last, I think, two videos, we had looked at both kind of how the foreign sector relates to the larger economy. And again, I'm doing this from kind of a U.S. perspective, so oftentimes I'll use dollars and that sort of thing. So I live in the U.S. and that's just kind of the world I live in. So in this case, the foreign sector and how it relates to the greater economy, and then also how the federal government or the Treasury and then the government central bank, how it relates to the greater economy as well, or kind of the greater the economy and the different parts of the economy. And as you notice here, one of the things that hopefully you've kind of picked up on is you can very much come up with three different sectors within this kind of economic model here. And this essentially covers everything in terms of what an economy can be and where money can flow from one sector to another. So you have the public sector, this would be the government sector, in this case, the central bank, and then obviously the government or the Treasury. You then have the private sector, which would be the financial sector, the banks, households, and businesses, all within the private sector, and then the foreign sector. And this will become important in just a second when we get to that point. But one of the points that I had made, and oftentimes, particularly those in the MMT crowd will make, is that all new money, this whole process has to start from the Treasury. That's the only place that new dollars in the U.S.'s sense can come from, is they have to be spent into existence by the Treasury. And these two lines right here will kind of indicate where the majority of that spending flows begin. You get a lot of money going to households via Social Security, other food stamps, Medicaid, Medicare, also that those funds can go that route. Obviously, those end up in the business category eventually, or you can just get direct business spending from things like NASA or military spending. The federal government can do that as well. So that is where the kind of the majority of new money comes from, and then ultimately enters the economy. Now, both businesses and households have one of two things to do with that money. They can either spend it or save it. Those are the only kind of two choices you have when you get income: save it or spend it. And either way, one of the things that we looked at is eventually that money ends up in the financial sector. So if a household decides to save that money, it's going to end up, and we'll go ahead and highlight this green just to kind of show the flow here. It's going to end up again in the financial sector one way or another. It'll end up in a bank. If a household decides to spend that money, say a cheeseburger or something like that, to a business, that money will go to the business, and then the business has a decision to make. Either it can spend it on some sort of other commodity from another business to make more cheeseburgers, or it too can eventually save it. And we can highlight that option. Now, there are more options. Obviously, this is a very simplistic model. Obviously, the business will have wages that it has to spend and that sort of thing. And there's a lot more that you could categorize the money flows as. But at the end of the day, you're either saving or spending it. And the big point is that at some point it's all ending up in the financial sector at some time, at some point within the life cycle of a dollar flowing through the economy. At some point that dollar wants to find its way, for lack of a better phrase, to the financial sector, and that's going to be important as we zoom in now on kind of an analysis of the last sector, and that being this private sector, the banking sector, in a kind of simplified economic model here. So I'm going to go ahead and change those back. Oh, apparently we're not. So that's really where I want to talk today now about what I want to talk about is that money getting into the financial sector and what that kind of consists of. So I want to go back to a point now that I just made, and that is that all new money has to come from the treasury of the government, has to be spent into existence. And in one sense, that's true. That's the only place new money can come from, true dollars that ultimately are on the liability side of the treasury balance sheet. That's where all savings from the private sector can come from. But in another sense, it's very much kind of a misstatement or a misnomer, because the financial sector has the ability to create money, and that's exactly what a new loan is. It is new money being created, but it's bank money, and it operates a little bit differently. Now, in a country like the U.S., this is not terribly apparent because we have a central bank that guarantees deposits. A lot of those deposits on the opposite side of the balance sheet are a loan. So if you if you buy a home and you get a mortgage, when you ultimately pay for that house, the transaction happens and you pay for that house, the person selling the house will get a deposit, and on the opposite side of the balance sheet, you obviously now have the house on your asset side, but on your liability side, you now have that mortgage, that loan sitting there. So that new deposit is new bank money created. Okay, so the deposit for the person who sold the home. Now that's federally guaranteed in terms of if the bank were to go under, that money will be there, so that the feds will step in and make that bank money real money. In other words, what's happening is that bank money, although we call it dollars, it looks like dollars, it functions as dollars, it's bank money. And occasionally, in the worst of economic crises, we actually see that bank money not trade at par with real dollars if there's some sort of belief that maybe the Federal Reserve will not be able to step in and back those deposits. So again, it's not terribly apparent because this doesn't happen all that often in the U.S. And in kind of, for the most part, modern history, although during the 2008 financial crisis, this did happen momentarily for a few banks. Nevertheless, that's actually what's happening. So to the normal consumer going through their day-to-day business, we're not noticing it, but that is the functionality that's happening. All right, so with these facts in mind, what I want to do now is pull up a chart real quick, and hopefully this can kind of drive some of this home. And this is generally referred to as sectoral balances. And what it's doing is it's looking at, in blue, this is showing the essentially the private sector flow, right? And in red, that is showing the public sector flow or the government flow of funds. And the green line would be the rest of the world. So remember how I said we can break up, and you can do this for any category. Obviously, the categories need to make sense, but we can break up the economy in the categories of the private sector, the public sector, and the rest of the world. And of course, accounting identity would tell you that if you arrange them in that order, that they will all need to cancel out, right? That it will all need to net to zero, and that is exactly what we're showing here. So what we're looking at then on this chart is in the red line, and I want to start here in this red line, and I'm kind of looking at the early 90s to the late 2000s right here. You can see this is the net lending or borrowing of the government relative to gross domestic product here, okay, or to GDP. And you can see that from the early 90s into the late 90s, we began to enter into a period ultimately of surplus. So we had shrinking deficits through the entirety of the 90s into just prior to 2000, when we actually hit a surplus for a handful of quarters back to back to back. And if you remember that time period, the late 90s was actually a time period of really accelerated economic growth. And in the model that I was just showing, in that flow of funds model, I've mentioned, and I'm a big proponent of big deficits, that you need big deficits in order to allow that money into the economy, to allow the kind of the flow of funds to go. So a counterpoint would oftentimes be, well, what about the late 90s? We had a very small deficit, a shrinking deficit, ultimately into into a surplus throughout the 90s. We had a booming economy. Well, where did that come from? Where did the booming growth come from? Well, it came from the banking sector. It came from the financial sector. The private sector leveraged itself up. If I go back real quick to the flow of funds chart, one of the things the households have the ability to do, same with the businesses, is they have the ability to leverage up. They can go into debt, and they are essentially borrowing or creating money, new money into existence when they go into debt. And that can allow this entire flow chart to continue on. That's where that new money is coming from. But as we just explained and it was just discussed, it is technically, even though they look like dollars, they spend like dollars, it is a different type of money than money coming from the federal government. And the fact that the biggest fact is it has to be paid back. Those loans have to be paid back. That's what the financial sector is in business of doing, is creating loans to essentially get the interest on the loan, and then that loan gets paid back. That's their business model. And so back in the late 2000s, we saw the late 90s, we saw a large deficit in savings, right? So instead of the federal government supplying the savings, so the federal government being in deficit, the private sector became in deficit to essentially leverage up the economy. And we all know how the following decade after the late 90s played out, and that what ends up happening is you get a massive private debt bubble. That's really kind of the main thing, the main point of this video, is that if the federal government isn't supplying the necessary funds for the economy, it will go into debt. And it can even do this even if the necessary funds are being supplied. And I mean, we're kind of seeing that live out right now in today's scenario. Is the private sector will leverage up. And so I can show this to you in a little bit more detail by switching to a chart that is now available on the Fed here, the Federal Reserve's economic data repository. And this is the private debt to GDP for the U.S. And you can see, in particular, after the 1970s into the 1980s, we had a lot of bank deregulation in the U.S. and even globally, and some other kind of socioeconomic changes that occurred. So you can see from that time period into the Great Financial Crisis, a very accelerated run up into private debt to GDP. And then after that, a massive deleveraging period from about 2009 into about 2015, where we've since kind of just trended sideways, slightly higher. And I can tell you, one of the things that I've developed over the years, and this is part of what I do, particularly in my analysis that I do over on the Patreon page, is we try and gather to the best of our ability, what this is going to ultimately look like in real time. What is private debt doing in real time? Because as you might imagine, this correlates very well to the economy. When we end up getting, what I'm going to do is turn this into change year over year. When we end up getting sudden slowdowns in private debt growth, that is oftentimes an indication that a major recession might be on its way. Obviously, 2008 was a great example of that, and that we saw a slowdown in that rate of change prior to the Great Recession, and it was a good indicator ahead of time that we were going to see a contraction. And there's some interesting reasons for this, and then I want to go into a little bit more detail on this before we kind of wrap everything up here. And essentially, what ends up happening is when you get a private debt load in any economy that's sufficiently large, usually about 150% or higher. What ends up happening with kind of the math and the way it works out, assuming you get a turnover of money, a velocity of money at a sufficient level year over year, that if you even not only get a decrease in private debt to GDP, but actually a slowdown in the acceleration, which is what we're looking at on this chart, right? Private debt to GDP continued to grow all the way through, I think, second quarter 2008, maybe even into early 2009, but we had a decrease in the rate of change, that's sufficient enough to actually contract GDP. And I mean, essentially what ends up happening is, again, you get the if you have a sufficient turnover of money, if the private debt load is at least about 150% or higher, obviously this can happen at any level given the circumstance, but the necessity for the economy to continue to grow year over year based on the acceleration of private debt becomes larger and larger, and then when that shrinks, you actually do get a contraction, like I said, in GDP. If you're interested, I will link a video that Professor Steve Keen, if you've been around and watched my stuff for a while, you'll know I'm a big proponent of what he's put together. I'll link a video about a year old now, but he goes into perfect detail, really good detail on exactly the math and how it operates to understand why a deceleration in private debt, given a sufficiently large private debt load, will cause an economy to ultimately contract. And again, I'll link that below. I think it starts a little bit after the actual example and math of it starts a little after the 10-minute mark in the video, but the entire video is worth watching, as is most, if not all of what he puts out is worth watching. So that is kind of the big point that I want to get at here is the final sector in this entire series to look at being the private debt sector, and it's really the private debt sector. I'm going to go ahead and switch back to our flow of fund chart. It's really this financial sector and private debt, along with the fiscal flows, that are really the two most important pillars in terms of really understanding where the financial economy is going to head. So as investors, as traders, those are the two sectors that if you can really get a good grasp on, you're going to have pretty good success understanding where the market is going to be heading at any given time, and whether or not you can really say, are we in a bull market or in a bear market? And so that's why every macro update we start with a look at where are the fiscal flows, where are the bank flows, and what is this telling us. It's not the entire picture, obviously. As we found out with the economic fallout after kind of the initial wave of the coronavirus, there are certainly externalities from this that need to be paid attention to, and there are other indicators and whatnot that can give us kind of a heads up on what might be coming. But for the most part, we've had very strong fiscal flows over the last decade, and very strong, or at least supportive, bank flows over the last decade. And that's why we've had really since after the fallout from the great financial crisis to today, a bull market. And even after the coronavirus sell-off, which was one of the most severe, steep sell-offs that we've seen in history in terms of just the breadth and the veracity at which we sold off, we've almost rebounded the entire way. And again, this is because we've had sufficient flows coming from both the federal government and the financial sector. We've seen a big spike in ultimately the expansion of private debt over the last few weeks. So months post coronavirus crisis. So that is kind of, I think, where I want to wrap this up, and kind of an overall explanation of exactly how to view the market and how to view the economy in a more heterodox view, and I think a much more helpful view in terms of understanding how the funds flow throughout the economy, and just to kind of drive this point home. As a trader, as someone who is actively investing, for me, this is really important. I mean, this is kind of the most important data you can have, because you can really define, hey, we are in a bull market right now, or we are in a bear market. And as it stands, as we'll look at in the rest of the video, we are starting to see some signals that might show that we could be entering kind of a bear market situation in the not too distant future. So for the most part, I've been pretty darn bullish on the market as a whole. I'm talking, in the bigger picture, we were able to see kind of the necessary signals to get out for the majority of the coronavirus sell-off, but even then, I still thought we would rebound quite swiftly. Obviously, that played out, and again, for the better part of the last decade, I've thought we've been in a pretty pretty bullish market. And one more thing, I guess, since it's popping into my mind, I know a lot of people have thought that have really, I don't want to say blamed, but given credit to, or blamed in some sense, or given credit to the Federal Reserve, the central bank, for a lot of what we've seen over the last decade now going on to almost 12 years since the Great Financial Crisis in terms of the growth that we've seen. And I think a model like this shows that really it's less the Federal Reserve. Granted, interest rates have had their play in it, but it's really the growth in the deficit that has allowed the continued kind of financial sector growth that we've seen. And I really think it's really is that deficit that is far more the contributor to the financial sector growth that we've seen than anything the Federal Reserve has done. So I think I think it's a good point to kind of end on there. That from this vantage point, from this way of viewing things, the Federal Reserve and what they're up to is a lot less important in the overall function than what you would normally kind of be led to believe, particularly in kind of popular media and even academic economic circles as well. That from kind of my view, it's going to be more the federal government and the financial sector that are far more important in the overall growth. So I will end this discussion here, and we'll get on to the rest of the update. All right, so that's going to wrap things up for this preview look of the macro update. And if you're interested in the rest of this update and everything else I do, check out my Patreon page over at patreon.com/CannonMA. That's where you can get the multiple updates I do each week. And that is specifically designed for traders, investors. So if that's you and you want to kind of see what else I'm up to, check that out. And again, patreon.com/CannonMA. If you're new here and you haven't yet hit subscribed yet, please do so. Make sure you turn on those notification bells as well, so you won't miss any further updates. And if you found this video particularly helpful, make sure you give it a thumbs up. Likewise. Anyway, I will wrap things up here. Good trading, everyone, and we'll see you next time. Bye-bye.